It is Wednesday, April 22nd, 2020. I'm Gord Long. As is normally the case, we have a lot of charts for us to go through, so therefore we'll pass over some of them quickly but leave you to examine them further at your leisure. You'll need to open your viewer to full screen viewing or you will not be able to see some of the detail I'll be discussing in the individual charts. A reminder before we begin, do not trade from any of these slides. They are for educational and discussion purposes only. This month, I'd like to highlight some of the dramatic, unprecedented changes that have occurred in U.S. monetary and fiscal policy under the premise that actions must be taken to counter the economic effects of the coronavirus. Let me state at the outset that though actions are required, those that are being taken are neither what they appear on the surface, nor are they going to be proven effective, in my opinion, regarding the magnitude of what is now required and quickly unfolding. As such, I'd like to discuss the areas highlighted here. I first want to revisit what we have been outlining over the last 6 months to place the recent monumental policy actions into a proper perspective. It seems quite telling that it was Vladimir Lenin who stated, and I quote, "There are decades where nothing happens, and there are weeks where decades happen." That is precisely what we have been witnessing, a regime change in policy. It is truly amazing what people will accept when fear, panic, and uncertainty are in the air. Politicians have long realized, as President Barack Obama's shrewd Chief of Staff Rahm Emanuel disclosed on The Politics of Washington, never let a crisis go unused. The coronavirus crash of 2020 was not caused by the virus. It was precipitated by the virus and made worse by the reactive decisions of governments around the world to shut down business and travel. It was caused by economic fragility. Fragility built on the shift from sound money to extreme debt and leverage and fostered by monetary malpractice. The supposed greatest economy in U.S. history actually was a walking sick man, made comfortable with painkillers and looking far better than he felt, yet ultimately fragile and infirm. The coronavirus pandemic simply exposed the underlying sickness of the U.S. economy. If anything, the crash was overdue. Too much debt, too much malinvestment, and too little honest pricing of assets and interest rates made America uniquely vulnerable to economic contagion, and for that matter, most of the developed world. As I said, the vulnerability was the result of monetary malpractice by central bankers at the Federal Reserve and their illiterate elected spendthrifts in Congress. We'll pay a terrible price for this policy regime change being enacted in the coming years. This is an uncomfortable truth, one that is obscured by the media while the public remains distracted by the virus. What did years of quantitative easing actually achieve? Symptoms of problems were readily apparent just last September during the commercial bank repo crisis. After more than a decade of quantitative easing, relentless interest rate cutting, and huge growth in excess reserves, more than $1.5 trillion, parked at the Fed, banks still did not have enough overnight liquidity? What exactly was the point of taking the Fed's balance sheet from less than $1 trillion to over $4 trillion anyway? Banks still needed money after a decade of quantitative easing? It begs a lot of questions. As with most crises, the problem took root decades ago in what I will label modern monetary policy phase 1, based on the allowance of unsound money to occur. Once it occurs, the roadmap to economic destruction is almost guaranteed, with no historical exception yet recorded. The era of modern monetary policy took root with the 1971 Nixon shock, which eliminated any convertibility of dollars for gold. Less than 20 years later, in October 1987, Black Monday wiped out 20% of the U.S. stock market valuations. Fed Chairman Alan Greenspan, for those who can remember, promised Wall Street that such a thing would never happen again on his watch, and he meant it. The Greenspan put was the maestro's blueprint for providing as much monetary easing as needed to prop up equity markets. The system began to change significantly. The tech stock crash of the NASDAQ in 2000 only solidified the need for new monetary policy. In 2008, that policy took full flight under the obliging hand of Fed Chairman Ben Bernanke, a man who not only fundamentally misunderstood the Great Depression in his PhD thesis, but who also had the self-regard to write a book titled The Courage to Act about his use of other people's money to reinflate the biggest and baddest stock bubble in U.S. history. The results leading into the shock of the coronavirus was an impairment of capitalism as we endorsed creditism. That is, a shift from productive growth as a result of savings and investment into productive assets to economic paper growth through rampant credit expansion and brazen consumption. At some point, this emerging economic edifice had to be tested or would be tested just as a matter of course. It appears the coronavirus is what triggered just such a test. The one thing you can count on, as I always end my videos with, is that the guiding principle that politicians will always print money to solve any and all problems. This is what we are witnessing in ways we couldn't have imagined only a few short months ago. What we also should not forget is that the powers to be can be counted on to change the rules of the game to keep the money spigot open. They cheat. Nothing will be allowed to impair the trough that Washington and its supporting crony capitalists sustain themselves from. And when I say cheat, rules that you come to accept, the basis upon which you're making decisions, they will be changed, and you will find yourself quickly with your pants down wondering what happened. Everything I can say can be found in the history of mankind, and that is why this graphic of the fiat currency cycle I've shown many times is perfectly predictable. The regime change we are witnessing is that of a shift from gluttony, shown in this chart, through monetary policy, to abuse through both the use of monetary policy and fiscal policy. Words such as debt monetization, helicopter money, MMT are the monikers of this new stage. These will accelerate a crisis of trust in the viability of the system, its leadership, the economy, and investment opportunities. Lost confidence leads to the next stage of slowing growth and economic stagnation. As we outlined recently, the quantity theory of money places hard boundaries that the changes in the rules can't actually alter and makes this process preordained once you're on this path. Politicians are trapped. Stagflation can be expected, and increasing levels of debt monetization and currency debasement. It's built in now. Nationalization through words such as conservatorships, guarantees, facilities become the new vernacular. Eventually, nationalism will even be accepted. So what specifically is the regime change we have underway? It is about policy changes in three areas: monetary, fiscal, and public policy. When you hear public policy, think taxation, fees, licenses, fines, confiscation, privatization, private-public partnerships, etc., etc. You are hearing about the tools, along with inflation, which is a hidden form of taxation, that pay for the monetary and fiscal policies, disguising what is nothing more than massive wealth transfer. Monetary policy, as we know it, is dead as a doornail. What we have is modern monetary policy stage 2. What central banks and central bankers do no longer falls within the realm of economics or policy. The Fed no longer operates as what we think of as a central bank. It is not a backstop or banker's bank as originally designed, at least in theory, nor is it a steward of economic stability pursuing its congressionally authorized dual mandate. It does not follow its own charter in the Federal Reserve Act. That is, it's now buying corporate bonds, which were not part of its mandate. It no longer operates according to economic theory or empirical data, and it no longer pursues any identifiable public policy other than sheer political expediency. Fed governors do not follow the rules. It answers to no legislature or executive, except when cravenly collaborating with both to offload consequences onto future generations. The Fed is, in effect, a lawless economic government unto itself. That may sound incredibly harsh, but as you'll see as we go along, that's what's happening. It serves as a bizarro world ad hoc credit facility, credit facility to the U.S. financial sector, completely open-ended, with no credit checks, no credit limits, no collateral requirements, no interest payments, and in some cases, no repayment at all. It is the lender of first resort and a kind of reverse pawn shop that pays top dollar for rapidly declining assets. The Fed is now the infinite bank. It is run by televangelists, not bankers, and operates on faith. The three areas shown here are all firsts in this regime change for the Federal Reserve and have never been done before and getting no coverage or media criticism. I will explain in a moment how this was allowed to occur without any rigorous public debate which actually occurred before the creation of the Federal Reserve at the turn of the last century. The short-term pain relief of these massive programs won't help those so desperately need the help, nor cure the economic financial disease. Rather, it will act as a catalyst for longer-term disruption and decline. None of the giveaways being touted will actually successfully get to the needy, nor address the core causes of our systemic financial disease: erosion of real-world collateral supporting the ever-growing mountains of debt and leverage, diminishing returns on monetary stimulus, that is, Federal Reserve's financial cocaine no longer generates euphoria, domino-like disruption of global supply chains and global demand, stagnating purchasing power of labor, the use of debt to keep up with the soaring costs of essentials such as rent, healthcare, childcare, etc., and aspiration goods such as iPhones and services like vacations. Repricing of risk and risk assets is completely gone, by the way. The stability of the entire system is increasingly fragile and brittle. The abuse of money printing, creating currencies to benefit bloated, inefficient, parasitic, predatory institutions, cartels, and monopolies is further eroding already decaying confidence in monetary and fiscal authorities and policies. These are harsh words, but they're words that the media refuses to use for whatever reason, but it is what is happening. The collateral supporting the global mountain of debt is crumbling as the speculative bubbles deflate, and I had a whole video on exactly this with Charles Hugh Smith about the impairment of collateral and the shortage of collateral. What happens to margin debt when a $300 stock falls to $100? What happens to the $1 million mortgage when the decaying bungalow's value falls from $1.2 million to $400,000? The inevitable result of creating currencies is excess of the creation of goods and services, is a decline in purchasing power, which we experience as inflation, shrinkflation if you would, getting lower quality and less quantity even though the prices have remained the same. It goes back to the old statement that I've said many times. Capitalism is about getting more for less, and socialism, and in its various forms, is about getting less for more. Despite the headline, Main Street is not getting a fair shake from the Fed nor from its new monetary policies. The money, through some magical and invisible and unexplained hand of the market gods, will not make its way to American workers and households in both a timely fashion and in the magnitude that you will quickly see will be required. It's all bunk. Here's what has actually happened that allows the Fed to carry out actions that have never been allowed before. The stimulus bill, that is called the CARES Act, stipulates that the U.S. Treasury will provide $454 billion. The U.S. Treasury will provide $454 billion of the $2.2 trillion total to the Federal Reserve. Remembering, the Treasury is the taxpayers' money. That $454 billion will be the loss-absorbing capital to leverage the Fed's purchase of toxic debt from Wall Street to a maximum 10 times or $4.5 trillion. So already Main Street is behind. Main Street is getting $2.2 trillion minus the $454 billion for Wall Street and $46 billion for airlines and national security businesses like meaning Boeing. That leaves $1.7 trillion versus the $4.5 trillion that will be offered to Wall Street, or $2.84 trillion more heading to bail out Wall Street. But the Fed had already created, if you remember, another Wall Street bailout program last year. last fall that is not included in that 4.54 trillion. The Fed's repo loan program has already funneled more than 9 trillion to Wall Street in revolving loans since September 17, 2019. So that makes it 13.54 trillion for Wall Street versus possibly 1.7 trillion for Main Street, if it's not siphoned off by loopholes in the new law. Those repo loans, as of yesterday, were being made at the preposterous interest rate of 0.1% to Wall Street firms that couldn't even borrow at 10% in September. It has been clearly stated by Federal Chairman Powell that the U.S. taxpayer that is putting up this loss-absorbing capital will eat any losses from the Fed's funding facilities for Wall Street. Let me repeat that. Chairman Powell has said that the U.S. taxpayer is putting up this low loss-absorbing capital and will eat the losses. The Federal Reserve is, in turn, handing almost all of this money over to the New York Fed. And please follow me as I go through this. So, the New York Fed has control of the facilities, which is privately owned, that is the New York Fed, by some of the largest Wall Street banks, J.P. Morgan, Chase, Citigroup, Goldman Sachs, and Morgan Stanley. For example, one funding facility, the money market mutual fund liquidity facility specifically, is the only one that will be run outside of this, and it'll be run by the Boston Fed. The New York Fed, in turn, is signing contracts faster than you can say rip-off with Wall Street firms that will actually be managing all of these facilities and the money, not the Federal Reserve and the Federal Reserve in New York. Contractors. They will decide what to pay for toxic debt they are buying from their Wall Street pals, if I can call them that. Another group of Wall Street firms will actually get to hold the securities that are purchased as the custodians. So there's contractors, then there's custodians. And there's value in being a custodian. J.P. Morgan Chase has been the custodian of the Fed's mortgage-backed securities, that is MBS's, purchases since the last financial crisis, despite pleading guilty to 3 criminal felony counts. J.P. Morgan Chase currently holds 1.46 trillion of the Fed's mortgage-backed security assets. They don't call it captured regulatory for nothing. This effectively means that the Treasury has merely laundered the money through the Federal Reserve, which has laundered it through the New York Fed, which has laundered it through a bunch of special purpose vehicles, or SPVs, organized within the secrecy jurisdiction of Delaware as limited liability corporations, or LLCs, in order to hand the money over to Wall Street asset managers. The fact that neither the Treasury nor the Federal Reserve Board are involved with the actual handling of the money is evidenced by the fact that these contracts are being signed solely by the New York Fed and the Wall Street money managers. The large asset manager BlackRock has already been named by the New York Fed to manage its commercial mortgage-backed securities program, its secondary market corporate credit facility, that is the SMCCF, and its primary market corporate credit facility, or the PMCCF. These are endless acronyms, but behind them are billions and billions of dollars. BlackRock will be allowed to buy up its own junk bond exchange-traded fund, that is an ETF, under the agreement for the SMCCF. It's unpoliced. It's unaudited. It appears, at least when I say unaudited. PIMCO has been named as the investment manager of the New York Fed's commercial paper funding facility, the CPFF. But according to Schedule 1 of the Exhibit A in the contract, PIMCO is limited to making purchases from the New York Fed's primary dealers, a list of 24 trading houses on Wall Street that includes subsidiaries of the owners of the New York Fed, J.P. Morgan, Citigroup, Goldman Sachs, and Morgan Stanley. This borders on being a cartel, doesn't it? Citigroup and Morgan Stanley were the #1 and #2 largest recipients of the Fed's emergency loan programs that secretly funneled $16.1 trillion to Wall Street from December 2007 to July 21, 2010, according to the audit conducted by the Government Accounting Office in 2011. the nonpartisan watchdog for Congress. Citigroup received below market rate revolving loans totaling $2.5 trillion, while Morgan Stanley received $2.04 trillion. Then as now, Main Street got crumbs. BlackRock's contract for the agency commercial mortgage-backed securities program is also restricted to making purchases from those same 24 primary dealers of the New York Fed. We have not yet seen the final terms for the other BlackRock managed programs. The New York Fed's repo loan program that began September 17, 2019, long before there was any COVID-19 crisis in the United States or anywhere else in the world, is also restricted to supplying funds to those same 24 primary dealers. And the largest of the Fed's emergency funding facilities from the 2008 financial collapse, the Primary Dealer Credit Facility, the PDCF, is back again. And wait for it, also restricted to those same 24 trading houses on Wall Street. Last time, the PDCF accounted for $8.95 trillion of the $29 trillion that the Fed created out of thin air to resuscitate Wall Street banks and their trading units, along with foreign banks that were the derivative counterparties to Wall Street. The New York Fed has not yet published a management contract or custodian contract for the PDCF. It says only that the Bank of New York Mellon will be in charge of pricing the collateral on a daily basis. This raises questions as to whether anybody is custodian of this collateral. Today, the PDCF is making loans at the same interest rate as the discount window, a contrived rate of 0.25%. 0.25% to some of the most dangerous Wall Street trading houses, whose parents have trillions of dollars in derivatives off their balance sheet. And when I say dangerous, I'm not trying to disparage them. I'm actually referring to the amount of off-balance sheet assets or derivatives that they're holding. So they're paying 0.25%. But these bank parents are in turn taking this almost free money from the Fed and continuing to charge high double-digit interest rates to struggling Americans on their credit cards. So here we have unemployed Americans or jobless Americans can't have any money and their credit cards are due, and now they're being charged the obscene rates that they may have been getting by without by paying on a timely fashion. Nothing is being talked about in any way of relieving them when the money is being given to the credit card lenders free. The PDCF is also accepting stocks, and I repeat, stocks, along with other questionable securities as collateral for these 0.25% loans. No wonder they want to drive the market up a little higher, pledge the collateral, and take the market down. They've got all the cash to lend out as people get hurt, and they got rid of the stock collateral to the Fed. Wall Street is basically an institutionalized wealth transfer system from the 99% to the 1%. The CARES Act put the wealth transfer system on steroids by letting Wall Street keep their decade-long obscene compensation, which was made by hiding their risk off their balance sheets, privatizing the profits, and now forces taxpayers to pick up the tab for the losses of the toxic debt. That is, socializing the losses. Treasury Secretary Steve Mnuchin has said this is nothing like the 2008 financial crisis, and yet it is everything like the 2008 financial crisis, except it's even a more brazen money grab. Switching gears to fiscal policy from monetary policy, we see in this chart the massive amount of money added to the national deficit in the form of relief aid for those felt to be directly impacted by the government's decision to lock down the economy due to no fault of their own in the form of shelter-in-place policies. Therefore, 22 million are now officially unemployed and impacted, millions in the gig economy. Small business owners are now forced to close, or larger business sectors brutally impacted by impaired consumer demand for their services, and the list goes on. Phase 4 from this, based on this three-phase program part already announced, is now on the drawing board, as the small business element was seriously underestimated and consequently immediately oversubscribed, leaving small business America trying to survive on its own. How congressional administered monies will be distributed, audited, and controlled is highly suspect and blatantly open to fraud, corruption, and bureaucratic entanglements. We already saw what the Fed's game can be like. Can you imagine what the bureaucracy here, which isn't used to doing this, is going to entail? The unanswered question is whether the funds required are even feasibly possible. Are they large enough? It's going to be massive. Time will tell. As the unemployment roll rapidly grows, as companies are forced into bankruptcies like the 90,000 J.C. Penney's or Neiman Marcus here last week, the numbers are exploding higher every day. Reopening America fast enough is becoming a crisis in itself. Credit rating downgrades and default waves are only beginning as banks dramatically curtail loans and increase their loan loss reserves by billions as they are forced to prepare for the obvious recession underway. These bank actions, which are completely understandable, are now working at frustrating cross purposes with the government's fiscal relief efforts. Most of this is being well covered by the media. That is, the shortage of money to the small business and to the average unemployed worker. What is getting little coverage is the level of pork being jammed into every relief bill. It is frankly beyond the pale, even for someone like myself who's accustomed to reading the small print. For example, millions of dollars are being pirated for Washington's National Center for the Performing Arts. That has nothing to do with the coronavirus relief. Examples like this are more the norm than the exception, and the list is long and disgusting. Meanwhile, small business relief is maxed out and awaiting Phase 4, which will probably be out by the time you listen to this video. Phase 4 continues to be held up as political horse trading goes on to reward those most connected versus those that are most impacted. Future disputes regarding fairness and equality of relief payments is going to be a can of worms, which everyone will soon regret having opened. This is going to be a cause and effect nightmare on steroids. I foresee, for example, the PPP or Payroll Protection Program becoming a historic game of fraud. I see insurance companies en masse refusing to pay out standard business disruption insurance policies on the grounds they were government actions or that pandemics are not covered. Of course, the taxpayer will once again be on the hook, and I could go on. The game goes on and on the longer the pandemic keeps the economy locked down. The regime change occurring in the U.S. is obviously profound with long-term consequences. What is getting insufficient attention is the fact that the U.S. economy doesn't work in isolation. As we discussed in our recent long-wave video, liquidity versus solvency is now a central issue, and we will soon see whether companies will in fact survive, or at least in their current form. Most U.S. corporations today are dependent on over 50% of their revenues coming from international operation. Who's going to bail out these costs? At what rate and from where do international operations then recover their costs to support U.S.-based overhead costs? State and city local governments have both incurred major costs and seen their tax revenues simply decimated. Will government relief be sufficient as we witness states like Illinois with their notoriously problematic spending policies now demanding their already abused, bled, and bankrupt public pension system receive coronavirus relief? Truly, they're actually filing for relief on this. As I mentioned, the default wave is only beginning, and with it, a domino of third-party related failures. Societies gripped by cataclysmic wars, depressions, or pandemics can become acutely sensitive to power and privilege. When society faces a common threat, exploiting a special advantage is morally repugnant. In normal times, corporations get special favors from Washington in exchange for generous campaign contributions, and no one bats an eye. Recall the Trump tax cut, which delivered $1.9 trillion to big corporations and the wealthy. In maybe all right in normal times, it isn't now. And I use that as an example of the anger and rage that I see coming as all of this unfairness and inequity and fraud starts to surface. If anyone still believes we're about to quickly get back to normal when we try and take off the pause button, they're seriously mistaken. We have mentioned many issues, but none may be more important in the short term than the workings and applications of the relief money by the Fed-incented contractors and the government ill-prepared bureaucracy for relief processing. The coronavirus rescue is a trickle-down plan. Many of the Fed programs don't appear even secondarily concerned with maintaining employment. The basic idea instead has been to hurl money at assets, underscoring the bizarre dualistic nature of this rescue. The financial bailouts are unconnected to any real-world crisis strategy. The result? We have disconnected parallel universes. Short-term, the Wall Street economy is being flooded with contractor help. In the intermediate term, meanwhile, the actual problem needing attention, being the real economy and consumption, is a mess. In the long term, what we are witnessing is massive risk transfer. Remembering, much of the Fed's rescue lending is backed by Treasury dollars, which means the taxpayer is eating what otherwise would have been the market risk of many of its investments. However, the Fed has shown no inclination to release any information about its activities. Oversight. Thus, this is a brave new world, not just in terms of economics, but also oversight. Essentially, the spending of huge amounts of taxpayer money has been outsourced to the Fed, whose ideas about disclosure simply suck, even worse than those of Congress. The problem in this crisis may, instead of being too big to fail, as in the last, be more about just too many to save. So in closing, as I've always reminded you, and it couldn't have been any clearer than in this particular video, remember the answer will be to print more money. It is the only answer politicians will ever agree on until no one wants it or trusts it. Invest accordingly. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing. However, it requires careful analysis and not following what has been traditionally the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2020 turn out to be an outstanding investment year for you and your family. And I thank you very much for listening.